Hello everyone, it's Fung here again. Today we'll be talking about bond ratings. And again, this information is sourced from the book The Truth About Money by Rick Edelman. So getting started, after hearing about all these investments, you're probably thinking, which bond issuers are safer than others? And the answer to that question used to be the bond ratings. And those range from AAA all the way down to D, and anything that was a triple B or above would be considered investment grade, while anything a double B and below was considered a junk bond. Now, the ratings also directly impact prices, because the lower the rating, the less investors would want, to buy it, right? And the more that the investors are going to demand from it. So companies have to pay more in interest to make up for this fact. Also, credit ratings impact stock price, because the lower the rating, the more likely, the company's at risk of bankruptcy. So this is where the problem begins. The problem is because Moody and S&P, who are like the biggest credit rating agencies, spend a lot of money on evaluating companies. But so how do they get, that money from so that they can evaluate? Well, they're paid by the very companies that they're supposed to rate, right? That's insane. So there's a conflict of interest here. You can already see that there can be a ton of corruption off of hearing that you're getting paid from the guys that you're supposed to evaluate, right? You can easily be swayed here. So of course, corruption between companies and rating agencies happened. Who would have thought, right? So the companies rewarded agencies with the most lenient evaluations. So hey, if they really deserved a C and they got an A, then of course they would reward those agencies, right? Because they look better now. And now the credit agency board members, they also were board members of the very companies that they rated. So that's so crazy to me how this even happened. And so a company that deserves a C would get an A. This misleads investors, and the company appears financially strong, but in reality, it's just below average. And the faults of the credit ratings, well, how valid are these ratings, right? It's very questionable. And the agencies are also really slow to downgrade companies. I think the company was called Enron, and they had like a really high rating. And then 5 days before bankruptcy, they lowered the rating. And then after that, they went bankrupt, right? Within 5 days, they finally changed it. That's so insane. Between downgrading the rating and then 5 days and then bankruptcy. That's how slow these guys are. Clearly there should have been earlier signs, right? And also these credit rating agencies were a huge factor in why the '08 recession happened, because it was also known as a credit crisis. And a ton of lawsuits and mistrusts swarmed these credit agencies following the crisis. And post 2008, there has been some reform. There was the Dodd-Frank Wall Street Reform and Consumer Protection Act, which had basically more transparency from agencies, more legal rights for investors, and it created the Office of Credit Ratings, which tried to regulate these credit agencies from doing these, corrupt stuff essentially. So after hearing about how sketchy these, ratings are and how valid they are, probably wondering, do they still matter? And the answer is yes, okay? Ratings still matter. That's because they have a huge impact on prices. So for example, a bond with a face value of $10,000 and with a rate of 8.4%, if you get that from a AAA issuer, the current price that you're going to buy it at would be $10,000, and the yield of it would be 8.4%, right? Makes sense, because they are, safer from risk. Now if you get that from a B-rated issuer, the current price would be around like $7,000, and the yield would be 11.4%. So you're looking at that and you're like, wow. So for the B-rated one, I get it cheaper and I get a higher yield. Isn't that better? But remember here, the difference is risk, right? The B is more likely to fail than the AAA. So the difference here is risk. So recap of everything that we learned. First is that the ratings are pretty sketchy, right? How valid are they after hearing about all this conflict of interest and stuff, and how they're a huge reason for the '08 recession? And ratings have a huge impact on prices for both bonds and stocks. And then ratings typically influence prices, yield, and risk, right, of investments. So that's it for the video. Thank you guys for watching. Like, subscribe, do what you will. You guys are not obligated to do so, but if you want to, follow my financial journey, then go ahead and do that. Thanks.